double dip recession is coming. We think that there's a double hump in inflation coming, which means it's coming down to come back up. And the problem is that most of this rallying has been because of a bunch of short covering by folks who were pretty pessimistic and negative after the last few inflation prints. So this is not really net new buying that we saw over the last couple of days. I've been telling all of our startups that you need to plan to have money through the first quarter of 2025. You must.
Oh, yeah. Okay.
You absolutely must. And the way that I frame that out to them is 8 or 9 quarters of cash, ideally 9. And the reason is that we have all of this positive news in the offing, but the problem is, again, there is still a lot of risk to the downside. We haven't seen David's second, dip in the recession, right? So that double dip is going to be expensive. And again, the sharps think that inflation will come back at some point in the next 6 months. That will keep the Fed's foot on the gas. Maybe it's 2 or 3 more 50 basis point hikes. The point is, Jason, you could be at 5.5. Again, we said this last week. We're going to get to a point that's probably higher than what people expect. That's probably around 5.5. And we'll stay there longer than people want. That's probably through the middle part of 24. And if you don't prepare for that worst case scenario, you're doing yourself a disservice. I think the market can start to rebound in the second half of 24. But if you're a company, you need to balance and plan for the first quarter of 25. Because, again, most venture investors are going to want to see 6 months of data on the ground that things are better before their sentiment changes. And we're just starting to see the drawdowns. We're just starting to see the impacts in people's portfolios. That will drive behavior change. I mean, this SBF thing is the tip of the iceberg in terms of the money at risk. I went and, by the way, I did an analysis since 2018 through 2021, and including an estimate for 2022, we have injected $1 trillion into venture capital. And if you look at historically how money has been lost in periods like this, and you layer that into 2018 to now, what it basically tells you is about $500 billion of that trillion from 18, 19, 20, 21, and 22 is going to be destroyed. We haven't even started to see that yet, right? And then if you factor in another 100 billion or so from older vintages, we're talking about a 600 or 700 billion dollar destruction of paid-in capital. So there's still, for all the good news, there's still a bunch of these unfortunate pieces of bad news that have to work its way through the system.
And for people who are looking at the chart right now, you just take a look at 1997. The peak TVPI was, 7.5x, 7.5 times, cash on cash money. And what actually got realized was 5x, right? So what paper said and what got distributed were two different things. Anecdotally, what I'm seeing in the startup world, Chamath, is people are taking the medicine and a lot of people are shutting their companies down. They're giving up on raising money and then asking me, which portfolio company can I get a job at? Because I, on my personal balance sheet, have been, taking a 5K draw a month and I have 2 kids. I need a job. Can you get me a job at Amazon or another portfolio company? And a lot of acqui-hires have started to happen. And so what's happening is the consolidation of talent, people who would be a great number 3 or 4 person, but maybe they weren't suited to be the number 1 person, are now consolidating into startups. With these layoffs at Meta and other corporations, we're starting to see very talented people who had peak comp of 300, 700K a year are going to go to startups or go to smaller companies. And that is also positive. More consolidation of talent, stronger companies.
So this is basically what we're dealing with, which is like, if you look at, and these are just a couple of examples, but this is Meta, Amazon, Snowflake, Datadog versus Gilead, Raytheon, and Exxon. What is the point of this? The point of this is just to show you that we have had a massive rotation away from our industry, is the point, right? Where normally the things that we would work on were just so well received by so many different kinds of investors that unfortunately just isn't the case anymore. And I think it just goes to show you that the reason why this is happening is because people are hedging their bets about how long the economic pain lasts. That's why, they'd rather be long healthcare stocks, industrial defense companies, and oil companies. Because at the end of the day, they're banking on oil and war and sickness versus
social media and e-commerce and SaaS software. And if we look at this chart, just
no matter how good, by the way, so this is not an indictment on these companies.
Go watch the prediction episode from last year. I think that
watch the prediction episode. Yeah, you and I nailed it on crypto. We both said crypto was going to crater. These four horsemen here, Datadog, Meta, Amazon, Snowflake down 23 to 27%. And then the Gilead, Raytheon, Exxon cohort 8 to 28% up. I think, Chamath, what this says also is we don't think your management style and how you're running these businesses is appropriate for this moment in time. Please consider some austerity measures and some thoughtfulness in how you treat shareholders. Vis-a-vis, well, I mean, it's just watching the number, how people are running companies. I think we took it too far in Silicon Valley. We took it too far.
J. Cal, I know it's sort of a pet issue of ours because we have to deal with some incredible hubris and arrogance sometimes on the boards of these companies because folks don't want to listen to reasonable advice and we come off as wet blankets. But that chart, to be honest, is because of what we explained last week, which is when rates go up, the value of a dollar that you earn today is just meaningfully more worthwhile than a dollar that you may earn even 2 or 3 years in the future. That's why that chart looks the way that it does. And if you believe that David's forecast of a double dip recession is accurate, which again, most of the sharps do, and then you also layer in this idea that inflation could come back, you have to be really defensively positioned. You can't take a lot of risk, which is why startups have to expect that if that's the dynamic and $600 billion is going to get destroyed in venture capital portfolios, how open are VCs going to be for business? They're probably not going to be that open. And so you have to plan, I think, for the early part of 25. Here's this really interesting setup. We have a bunch of very positive news that I think we all have to process. First positive news was that inflation ticked down. Now, here's what I'll tell you. There's a caveat here. I talked to a bunch of pretty smart sharps on Wall Street, and double dip recession is coming. We think that there's a double hump in inflation coming, which means it's coming down to come back up. And there's a bunch of reporting vagaries that may cause that. So keep that in the back of your mind. But positive news number one is inflation ticking down. Number two, Jason, we talked about this. A federal judge basically stayed Biden's attempt at giving student loan relief. Now, that would have been a $500 billion transfer payment from the government into the hands of individuals. It is deflationary to not give that money to people. It's effectively taking stimulus away from folks. Number three, it looks like we're headed towards a split government, which means that we are not probably going to see any more stimulus over the next 2 years. Number four, Ukraine wins in Kherson. Number five, the United States announced yesterday through the Wall Street Journal that they had essentially said no to Ukraine's request for advanced drones. And they said to Ukraine, essentially, you need to go and negotiate an end game here. And number six, China has started to relax its COVID policies and Xi is pivoting to economy first. These 7 things are macro level things that affect everybody. And I think if you take them together, what it says is that, wow, there's the potential for a lot of great positive developments over the next 6 or 9 months. And I don't think that was adequately priced in the market. But here's the problem. And this is why we've been rallying.